Good day, fellow investors. There is a private equity bubble out there, and we have to discuss what's going on there. Why are all these Apollo, Blackstone, KKR, Brookfield stocks all booming? Now they have retreated a little bit, but we need to do a deep dive into private equity, what's going on, understand the opportunities, the systemic risks, and how to move alongside what is now a huge part of the market. For those who don't know me, my name is Sven Karlin. Have been telling you about bubbles here on YouTube for a while, from the marijuana. We have discussed ARK investments at the peak of ARK when the stock price was 120 here below. So that is something. I also told you that you must go beyond sanity to buy companies like BYND. So you're welcome, also NEO and things like that. So we discuss that, understand the risks, and simply stay away from such investments. That's of course the first step, but there are other consequences. I listened to the interview, this on Bloomberg, from Apollo CEO, and in short, he has been discussing how it's a great industry, great opportunities, huge runway, huge growth ahead, everything looks great for them. And what he wants is investment grade, private investment grade. He wants more money from the pension funds so that he can make more money on the fees. And then I look a little bit deeper into the sector. All the news is, I don't know, Brookfield nears 950 million purchase of Dewey Homes. And I just look a little bit at the numbers there. 100 million in revenue in 2022, and they are paying 9 times revenue. Maybe they grew a little bit, but that's still, I don't know, 6 times revenue. How much are they paying? So that is not safe infrastructure investing. These are very, very risky bets that those companies are making. Another example, I'm just starting with Brookfield here. Chemelex bought from nVent Electric for a purchase price of 1.7 billion, and nobody says what they are buying. I looked a little bit, they say, okay, they have equity, 830 million, that means 1 billion of debt. Then the Brookfield partners go for that interest, and then they also take likely 1%, 2% fee on that situation. Then I go dig a little bit, nVent, the company that is selling, and if you look at their latest presentation, well, we have now 2 billion of cash available for significant capital deployment. So this sale is great for them that are in that business, that have been in that business, and then Brookfield that hasn't been in that business acquires it because these guys are geniuses. But then I look deeper, 2022 free financials, total sales have been 3.3 billion, thermal management, what Brookfield acquired, is 18%, which means total sales, let's say 600 million. So Brookfield paid 3 times revenues. The thermal management segment has been also declining. 3 times revenues, let's say 10% operating profit margin at best, but if it is that high, why would they sell? So that's 40 times operating earnings, that's likely 40 times price earnings ratio. So they are just buying whatever. Why? Because Brookfield doesn't care about the business. They will say, from now we paid 1.7 billion, they will just increase it by 10% the value, because from now on it's not market priced, it's Brookfield priced, and they will get the 1.22% fee on this 1.7 billion, and that's it, my friends. So they just keep on doing acquisitions, renewables. Everyone is happy to sell to Brookfield, and we also discussed this in this video, how it is very, very risky what they are doing. They also bought this in France that we discussed more there, but the market cap is now 6 billion. What are they paying? 6.8 billion, I think, 12 times EBITDA. But then I look a little bit more at the numbers, then I see net income of 147 million. So there is something even more important here. Yes, you say total assets 7 billion, but they are buying the stocks. So that means they are also taking over 3 billion in debt, non-current, another half a billion, another current. So that's 4 billion in debt. Brookfield will likely borrow another 4 billion to pay for the 6 billion acquisition. So now we have this company with 8 billion of debt on it compared to 150 million of net income, 8 billion of debt, and then there is Brookfield's 1.5% fee on that, which means that this is totally crazy. No way Neoen Group can sustain paying the fee, the interest on the 2x debt now. So this is completely a bubble, a Ponzi scheme, however you want to call it. And then there is so much money in the sector. Everyone, they just simply find new billions for new funds. They go gather the money from, I don't know, under-intelligent pension funds, we'll discuss that later, and buy whatever there is for sale. Bridge acquisition, Argo Infrastructure Partners, again here acquiring Bridge for 1.5 billion, but if I look at the profits, those profits are really minimal, but yes, it is worth 1.5 billion. We will get more fees from the assets under management, and just pushing and pushing 1.5 billion for, what is this, 400 million in equity. Okay, whatever you say, but the market has been great for them, the stock has been loved. This is now a little bit down over the last month as more people have started discussing the private equity bubble. But then again, Instructure, acquired by KKR, paid 4.8 billion for the stock, thus also assuming the debt. Net loss, so they are buying companies with net losses, 30 times EBITDA, but yes, the margins there, the potential, the total addressable market, which is something I learned in elementary school, that whenever you see total addressable market on an investment presentation, run away, but they are happy to pay 4.8 billion. And then you look at their presentation, it's 200 slides on how geniuses there are. And yes, they are, because they were doing this and now they are doing everything. Why? Because the market is there, pension funds are giving them money, private investors are giving them money, and they simply collect fees. Look at this, boom, 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 fees, fees, and fees. And I listened to this guy, the CEO of a Norwegian investment fund, and he says that they are not doing private equity because of the high fees. When you calculate and you look at the fees, what's left for pension funds on top of the debt payments will be a big zero. And yes, you are saying, but Sven, everything grew, everything was great, look at the stocks, look at the returns, look at the projections, look at this. They project that in 10 years they will 5x their net income. Yes, but it is all built on a bubble. They have no investing acumen, like they say. They are not geniuses. They are just riding the tailwind of people who are giving them money to do so and charge high fees. Now they are chasing private wealth, as they have likely used up the institutional wealth. So now they are after you for your money, huge trillion opportunity markets. And for now it works because everyone is interested in these alternatives, especially after interest rates here were zero. So you were looking for alternatives, which was the smart thing to do, but not anymore. As you will see, prices have changed and they are constantly inventing new ways to get to more fees. Yes, they are geniuses for accumulating fees, not so much for your returns. Going forward from now, of course, inventing all the kinds of ways, tokenized funds. They even compare themselves to Berkshire in a slide, say, okay, the asset management industry going into growth, new ways to make more money because they are geniuses. And then again, adopt the Berkshire model. Yes, Berkshire model is working because of Warren Buffett, not because of this. If you go to the movie The Big Short, well, they are stacking investments that after they buy, nobody knows what's in that company, in that asset management, in that fund. Suddenly there is no market price, the price is what they say, so the return is what they say. And let's compare it to the mortgage bubble. If we go to the movie, dog shit things there, rock bottom FICO scores, no income verification, adjustable rates, defaults rates up from 1 to 4%. This was in the Big Short movie. Compare to what's going on. They are buying whatever business. The debt there is irrelevant because they are just funding it. 30 times operating income, P ratios of 40, you don't even have net income, so no income verification. They don't care, they are just buying and that's it. That give me more. But if we look also at default rates, PE-backed firms are suffering higher default rates, especially as interest rates go up. So Platinum Equity had the highest number of share defaults out of Moody's ranking of the 12 largest sponsors, followed by Apollo Global Management and Clear Lake Capital Group. So, of course, they say lowest in the industry and things like that. But the thing is that private equity firms have borrowed against their funds, combined assets, tapped private credit, and utilized payment-in-kind features to manage diminishing cash flows, Moody's said in the report. For decades, the business was great. They managed to fund themselves, raise money, debt, exit at a profit, and convinced happy investors to do it all over again. But this works until it doesn't. So we are looking at the market. Everything is expensive. Price to free cash flow of the S&P 500 is very low, 3%. But total private managers are fundraising more and more money, and you can compare it, similarities to the mortgage crisis. So the thing is that highly leveraged, again, highly leveraged, risky lending practices, can't afford mortgages. As I said, NeoN will not be able to pay interest rates on the 8 billion of debt and the fees and the everything. So that is very complex financial engineering there. But as long as it works, and everyone, oh, why didn't you invest 15 years ago into private equity, Tony Robbins, and potential systemic risks. However, there are also differences. Of course, this is just asking ChatGPT to summarize all for me. But if we look at their highly liquid and widely owned assets, now that is illiquid long-term holdings, meaning issues could take longer to surface and unwind. Rapid contagion in the mortgage-backed system, and we will see whether this will be a rapid contagion or not when it spills off. But also, job losses, it can have big influences on the market. Now, if you want to know more on private equity, let's hear it from our assistant, our dear Warren.
I would not get excited about so-called alternative investments. You can get all kinds of different figures, but there's probably at least $1 trillion committed to buying, in effect, buying businesses. And if you figure they're going to leverage them, 2 for 1 on that, you may have $3 trillion of buying power trying to buy businesses in the U.S. market, maybe something over 30 trillion now, but there's all kinds of businesses that aren't for sale in that thing. So the supply-demand situation for buying businesses privately and leveraging them up has changed dramatically from what it was 10 or 20 years ago. And I'm sure it doesn't happen with your Winnipeg operation, but we have seen a number of proposals from private equity funds where the returns are really not calculated in a manner that, they're not calculated in a manner that I would regard as honest. And so it's not something If I were running a pension fund, I would be very careful about what was being offered to me. If you have a choice in Wall Street between being a great analyst or being a great salesperson, the salesperson is the way to make it. If you can raise $10 billion in a fund and you get a 1.5% fee and you lock people up for 10 years, you and your children and your grandchildren will never have to do a thing if you are the dumbest investor in the world. Charlie?
Well, I think what we're doing will work more safely than what he's doing. But I wish him well.
Yeah, Brent, you sound like a guy that I would hope would be working for a public pension fund, because frankly, most of the institutional funds, we had this terrible right here in Omaha, and you can get a story of what happened with our Omaha Public Schools retirement fund, and they were doing fine, and until the manager started going in a different direction, and the trustees here, perfectly decent people, and the manager done okay to that point, and it became.
They were smarter in Winnipeg than they are here.
Yeah, well,
that was pretty bad here.
It's not a fair fight, actually, usually when a bunch of public officials are listening to people who are motivated to, who really just get paid for raising the money. Everything else is gravy after that. But if you run a fund and you get even 1%, of $1 billion, you're getting $10 million a year coming in, and if you've got the money locked up for a long time, it's a very one-sided deal. And I told the story of asking the guy one time in the past, why in the world can you ask for 2 and 20 when you really haven't got any kind of evidence that you are going to do better with the money than you do in an index fund? And he said, well, that's because I can't get 3 and 30.
What I don't like about a lot of the pension fund investment is I think they like it because they don't have to mark it down as much as it should be in the middle of the panics. I think that's a silly reason to buy something, because you're given leniency in marking it down.
Yeah, and when you commit the money, in the case of private equity often, they don't take the money, but you pay a fee on the money that you've committed. And of course, you really have to have that money to come up with it at any time. And of course, it makes their return look better if you sit there for a long time in treasury bills, which you have to hold because they can call you up and demand the money, and they don't count that. They count it in terms of getting a fee on it, but they don't count it in terms of what the so-called internal rate of return is. It's not as good as it looks, and I really do think that when you have a group sitting as a state pension fund,
or all they're doing is lying a little bit to make the money come in.
Well, that sums it up.
This man has this wonderful horse, and it's just a marvelous horse. It's got an easy gait and good looking and everything. It just works wonderfully, but also occasionally just gets so he's dangerous and vicious and causes enormous damage and trouble and breaks arms and legs for his rider and so on. And he goes to the vet and says, what can I do about this horse? And the vet says, that's a very easy problem and I'm glad to help you. He says, what should I do? And the man says, the next time your horse is behaving well, sell it. Well, think of how immoral that is. And haven't I just described what private equity has to do?
So, thank you, Warren. I think that summarizes perfectly where we are, but we can dig deeper. The key factor when private equity was booming was this. Look at these crazy interest rates, and look at those interest rates in the private equity now. So that is a huge difference when you go buy businesses at 30 times equity. Here you are doomed, here you are a genius. But the deals are getting bigger and bigger, as we see constantly in the news, acquiring whatever is there. And this is the key. Yes, if you purchase at EBITDA, 7 times EBITDA, and then things go well, no recession, no nothing, you get your 10-13% return. If you purchase at 12 times EBITDA and then you have a recession, you go bust. That's the difference between private equity now and 10-15 years ago. But now, when prices are high, total buyout deal value goes skyrocketing. And what's my take here? I'm looking at this because I invest in businesses that when they are taken out by private equity, then I make a lot of money. So I have to look into private equity because they are a contributor to my long-term returns. And I have to see, okay, this can go on, I hope it goes on, but for how long is the key question. The long-term risks can create opportunities. The systemic risks are surely piling in the environment. The catalysts are recession, interest rates, funds redrawing their money. And to be honest, this is nothing new. You just go to Wikipedia, just read a little bit about private equity in the 1980s. There was the boom. And look at this company, Kohlberg, Kravis, Roberts, KKR, living there, going almost bust and then surviving and now booming again. So this is something very interesting. And I think this is just a reflection of the financial excesses that have been accumulating over the last 15 years, especially with money printing and zero interest rates. So is this a bubble? Yes, it is, especially if they are paying 40 times earnings. Profits there have been declining, and even more given the high prices they are paying. And also the business model is changing. They would buy and sell it to someone else quickly at a profit. Now they are turning into long-term holders because they cannot sell it to anyone. And gross multiple on investment capital is declining the longer they hold. The key, as always, Charlie Munger says, show me the incentive and I will show you the outcome. What's the outcome? Well, no profits except for them because they are charging high fees, as Warren Buffett said. You go into that industry, you find 10 billion, get a 1% fee on that 1.5, you don't have to work ever again. That's the business model. So if you want to make money, forget about investing your million, go into private equity. And this is perhaps the key. Warren Buffett is waiting with 350 billion in his cannon, and he's waiting for private equity to unfold because he cannot compete with private equity. Warren Buffett likes to pay 10 times earnings, like he did with acquiring the last part of Berkshire Energy, but the rest is crazy. So we will see how will this evolve. I just wanted to research a little bit deeper into private equity. One fund is buying part of a company that I own, so okay, I hope it gets financed and the private equity doesn't burst before I get my money, but it's very interesting how things are going. Will the Fed save private equity? We will see. It is extremely risky, and of course, anything can happen, but the risks are certainly there, are hidden in the balance sheets because they will not tell you, we own this, this is financed like this is the profit, because that would be crazy for them and would simply dismantle the whole business model. Price matters. That's why value investing works. That's why Berkshire has been around for 50 years and all these other players emerge from whatever issues they had, then they go boom and bust, boom and bust. Thanks for watching. I hope you enjoyed. I hope you learned something, and I'll see you in the next video.